The following is a presentation of TFNN. Trade what you see with Larry Pesavento. Call now, toll free at 1-877-927-6648 or internationally at 727-873-7618. Now, Larry Pesavento.
Okay, looking good, Billy Ray. Feeling good, Lewis. We're going to have Stan Harley as our guest today at 9:30 our time. I want to start with the gold market today for two reasons. One, I think it's really important the area we are right now. Down here, of course, you know, we've made lower lows here because we're looking for it to possibly get to about 1810. We've got the election coming up, and believe me, and if we have any volatility like we had in 2016, it's going to be pretty crazy. So we're still looking for it. The low that we made there yesterday at the 1859 level was just a little below the 78% level, but we're still being very, very cautious here in the gold. So we still believe we're going to go a little bit lower, and then it's going to be a great buying opportunity. It might be related to what happens with the election that's going on. So that's all we are talking about with the gold today. I want to focus here on a stock today. It's in the news quite a bit, and it affects all of us, of course. But this is the stock of Twitter, and I was watching the PBS yesterday when they had these guys here from Facebook, Google, and Twitter. And folks, we've got a major problem here, man. These guys are so arrogant that they flat out, they don't care what the government does, and they shouldn't, because the government doesn't do a damn thing. So it's our own fault. We don't have anybody, congressmen or senators that have any chutzpah. So they're not going to do a damn thing. So we just have to live with it, and we will live with it. Now here is Twitter. You notice yesterday at 53, we made a 1.27 expansion of the August high. We made a 1.618 expansion of the February high. We made an ABCD pattern from July through November, and we're trading down at 43, down $10 today. So that's a 20% handle in just one day. That tells you that something happened in Twitter. So I don't know what's going on, but we'll see what's happening. Okay, let's move on here. Please don't ask me any questions about November 3rd. I really don't know. Let's just forget about that. I don't even want to think about it, because people ask me questions and I can't answer them, so I don't want to answer them. So it's just over my pay grade, folks. I do one thing really well. I can look at a bar chart and tell you whether I think it's got support or resistance. That's the bottom line. Anything past that, you're asking the wrong dude. You know, I'm not a rocket scientist. I'm not a physicist or anything like that. I spent all my time, in the sciences, and I basically found something that works for me, and it works for a lot of other people too, folks. Believe me. So let's take a look here. One of the questions that one of our listeners brought up twice to me yesterday, and that is when to know when to change your opinion of a market. So let's just get up here and take a quick look here at a market that we've been watching for quite a few days. We had Ruby talking about this in the Tiger Den 3 or 4 days in a row when it was trading at that 103.50, and we said, Ruby, watch it at 102.50. It went to 102.50, and it's now trading at 108. It's actually up a little bit this morning too, but you can see the explosive move here. Now the question that the young man had is that, when do I change my stop? Well, you look at this market went from 102.50, it went up to 105.30. That's 3 handles, folks. That's $1,200. That's $1,200 in cattle. That's a lot of money. Now, look what happened. And it came all the way back down to 102.50 again. Well, if a person put his stop there at break even, he would have missed that last 5.5 points. I can't tell you when to change that stop. I really can't. I wish I could. But I will tell you this. If you buy something at 102.50 and it goes $1,200, you ought to protect some of it. Okay, now when it goes back down there again and doesn't take out that low, that is telling you something. And if you're patient enough to look at it when it goes up to 105, you should be patient enough to watch it on the pullback at 102.60. But it just amounts to most of these things that we use, these patterns that we use, work almost immediately. And I'm talking within about 30 minutes or so. Now, if this market would have gone to 102.60 and then started to go lower, there's no way in heck I'm going to sit there with a 1.5 point loss trying to pick a bottom in there, because it's so perfect that if it doesn't fit, then, why bother? That's what I'm looking at. I hope that helps. But, it's really difficult because everybody is different. Some people don't look at the machines very long. I certainly don't like to watch prices anymore. I used to love to watch prices go up and down, but frankly, I don't do that anymore. By the way, Stan Harley will be our guest today. If you have any questions, 877-927-6648. And we are having some really great volatility, folks. There's some big things happening here in the market. Let's just take a look at what happened to the S&P last night. I just want to get this up here to show you where we were. Let's just move this around here 1 minute here, and we'll see. Here's where we were last night. We were down about 90 handles, I believe, after we hit that 33.30. What did we do? We rallied from 32.25 all the way up to 32.90. That was an exact 61% retracement of the high from 33.30. Now, I know it doesn't work all the time, but it works some of the time. You should pay close attention to it, I would think, so that's what I'm looking at here. All right, now there's a perfect one that works right away. If you sell it at 618 and it don't work, you just get out of it. Take a lot of small losses, It's an old Italian proverb, folks. You want to eat like an elephant and poop like a bird. Anyway, let's move over here and get over here to one of these things here that we have looking at it. Here's one that's been really good to us, and this is this Treasury bond. If you listened to us yesterday in the Treasury bonds, we said to be a seller up 75. It dropped down to 170, right down to our buy price at 173.01. And now it's rallied up a little bit from there, so that 171 low that we made this week is extremely important. If we take that out, folks, these bonds are going to go lower and not higher, and that means interest rates are going to go higher. That's what I don't know. One of the questions that came up again last night was, is there going to be a crash in the stock market? Well, guess what, folks? I have no idea, but nobody else does either. There's all kinds of things in the internet about these things that are going on. And believe me, the internet's a very dangerous place, as you know. There's a lot of stuff that goes on there. We don't even talk about the dark web. That's even more sinister than you could possibly imagine. But yes, we will. You're right. Marshall is correct. We will have a crash someday. But it's not that important, folks, because the Federal Reserve is in there, and they're going to be doing things like pretty much like they couldn't do during 2000 or during 1987, because they didn't have the what do they call those triumphant, what do they call those three dudes that did all that stuff? I can't remember the name of them. The not Trilateral Commission, whatever they were. They were there to help us. We got the break is saving me. We'll be right back.
If you're not currently using the TAS Profile Scanner when looking at setting up your trading opportunities, then your arsenal is short a mighty weapon. The TAS Profile Scanner is a standalone piece of software that instantly filters over 2,500 global financial markets such as stocks, ETFs, commodity futures, and Forex. Headed by Steve Dahl, TAS understands that in today's technological world, the use of top-flight software applications and technical analysis expertise is essential to successful trading in today's market. You also gain access to the webinar that Steve Dahl and Tom O'Brien just hosted, The Best Way to Use the TAS Profile Scanner to Profit. This webinar archive is available for all subscribers immediately upon signing up. All new subscriptions also come with a 30-day money-back guarantee, so you have nothing to risk. Start your subscription by visiting the front page of TFNN.com today, and you'll find the TAS Profile Scanner under the Services tab. Sign up today. Are you in the market for buying or selling real estate in the Bay Area, including the surrounding St. Petersburg, Tampa, and Clearwater markets? Tiger Real Estate LLC is a firm that has extensive experience in the Tampa Bay area. Whether you're looking to sell your current property for maximum value, or you're in the market for a second home or investment property, Tiger Realty has the experience across all areas of real estate in the Tampa Bay area to help buyers and sellers make the most informed decisions across all price levels. From the price you should be paying per square foot in certain up-and-coming areas to the type of cash flow investment properties are capable of creating, Tiger Real Estate can help you make the best decision when it comes to all areas of the market. Before you make one of the biggest decisions of your financial future, call Tiger Real Estate LLC today at 727-329-8322 or email us at tiger@tfnn.com. That's 727-329-8322. Call us today.
Many of our new listeners have heard about The Tiger's Den. The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of the TFNN shows, plus see all of the charts as they happen live and have access to archives of all of those charts. You can test drive The Tiger's Den absolutely free for 30 days and greatly enrich your knowledge of these markets and how to make your money work for you. Details on The Tiger's Den are on the front page of TFNN.com.
TFNN has launched our brand new website. You can still visit us at the same TFNN.com URL, but when you do, you'll see a new and improved homepage with a much simpler navigation, whether you're watching Tiger TV live in high definition or just accessing your newsletter subscriptions. We even have new pricing in 6 months and yearly options. Check out the new TFNN.com now and experience all the upgrades. TFNN.com, educating investors.
Call now, toll free at 1-877-927-6648. Internationally at 727-873-7618.
Okay, folks, I posted the chart that we've been watching all week, which was the S&P 500, and you'll notice here that it's been in a downtrend. You can see that easily by the lower tops, lower bottoms, and what we did is we said there was some support that if it broke that 3,300 level, that it would be relatively weak, and it was weak. It kept going lower. It went all the way down to 3220, but when it got to 3220, it did something interesting. For the first time in a long time, as we got a pattern that we believe in, and that happened last night when we hit the 3 drive to a bottom pattern down there. And believe me, this is an important bottom, folks. Below 3225, there's very, very little support. Remember, the 78% retracement on this whole move came in at 3240. And so we went down there on the news. You can see the big drop. We went from 32.75 to 32.25, just in a heartbeat because of what happened with, I don't know which one it was, but one of those stocks didn't do. Oh, Apple. Apple didn't do very well. By the way, Mr. Bill told us it was a plunge protection team back in 1987. I believe it was Alan Greenspan, Robert Rubin, and I can't remember who the other crook was that was on the group, but they basically came in and opened the doors of the banks. I don't know if you guys know why the market bottomed in 1987, but what happened was the Federal Reserve went to all the banks and all the brokerage firms and says it stops going down today, and what we're going to do is we're going to allow you to mark your positions to the market, not what you bought it at, but where the market was trading. And that made every difference in the world because now they had money to come in and buy. Before they were on margin calls and they couldn't. So that's what happened, and that's what turned it, and away it went. So let's just remember that. It's very, very important. Okay, I hope that I answered that question about I always loved the county. But anyway, the reason why I spent some time on the gentleman's question about when to change your orders and stuff, it's very, very difficult because everyone is different. The one thing I can really give you help here, folks, is to don't watch the machine all day long. If you're learning, sure, you can watch something else that you're not trading. But if you're in the S&P, go look at natural gas, or go look at Twitter, or go look at something else. Don't look at what you're watching, because this monitor will just suck the energy right out of you. I mean, it really does. And especially if you're watching your equity go up and down, those are terrible things to do, because it gets inside your head. You know, you're watching prices go up. Oh boy, this is great. And then you're watching prices go down. Oh, goodbye house, goodbye car, goodbye boat, goodbye wife. You know, this is why it's terrible. You know, it'll just drive you nuts. So what I do is I've trained myself to look at it about every half hour or so after I put something on, and then not to worry about it. Back in the old days, we didn't have to, because up until 1983, we didn't have all this information coming to us. We got it off a Reuters machine or a ticker tape coming from the Board of Trade or the Merck or the New York Stock Exchange. I mean, that's where we got our information. But that's different now. Things are totally different. So let's take a look now at the Nasdaq, because this is another one that's really big. Let's just look at this from a little bit longer term picture. We're coming into an election here. You'll see we went above the 78% level, the high we made, of course, back on September 3rd. Then the market breaks down really badly. We rally up into September or to October 11th, and we've been straight down now. We haven't quite made the 78% retracement here yet in the Nasdaq. So, and 0.76 is the fib number, but I don't use that one. But it's there. But the thing is, we made that three drive to a bottom pattern in the S&P, and that's not an easy thing to do, and it did it. So as long as we stay above 32.25, we've got a chance for a rally coming in here. Now, people ask me all the time, is that going to be any playback on what's going to be happening with the election? I have no idea, but nobody else does either. All I know is there's going to be some big things happening. Okay, let's move on to one other one that I wanted to cover. I covered the bonds. I've covered the gold. I've covered just about everything I wanted to cover this morning. I think I'm done for the day. I better just hang up and wait for Stan Harley. Oh, the last one I wanted to bring to your attention is a longer term one, because if you'll look here, the market is top heavy as far as looking at the breadth of the market. As you can see here, if you'll watch your way back in 1972, 2000, and where we are right now, this is the percentage of stocks beating the S&P 500 over the last 12 months. I mean, there's less and less stocks winning, and that's what we've been seeing in the Nasdaq. And the Nasdaq has finally started to show some weakness. The key level to watch, folks, is 32.25 in the S&P. Below that, it's really in bad shape, because we're breaking below the 78% level. Does this mean it's the end of the bull market? I have no idea. I'm just looking at things that say this is support or resistance, and whether you have a trade there or not. When I try to put a trade on, I've got to have certain things set up. I've got to have a very good ratio, a very good pattern, and to tell me this is where I should be right now. And if I'm not there in an hour and a half and it's not moving in the right direction, yes, I will lower my stop. But if it's working in my direction, like the S&P did earlier this morning, then yes, that's fine. Then I'll do that. But that's all I'm doing. These things are there for risk control, and they do have some area of predictability, but by far they're not perfect. When Andrew Lowe wrote his book, The Non-Random Walk Down Wall Street, he said these patterns are terrific because they repeat over and over again. They're predictable within limits, but they're not perfect. At the best, they're probably 80-85% on some of these, which I think the three drive to a top pattern is probably, and three drive to a bottom pattern is one of the better ones, because you've got so many numbers coming together. So I hope this helps. I'm telling you this from what I see. I can't get inside your head, but the thing that'll hurt you the most in this business is putting your stops too close and watching this damn machine, because, going to be blocked by the CFTC again. What is FCC or whatever it is? Sorry about that. Anyway, that'll get you in trouble, because what it does, it starts you to focus on the money. Don't focus on money. Folks, this would be the easiest job in the world if we didn't trade for money. If it was just for peanuts or for little beads, it would be totally different. But because money is involved and it's very emotional, that's what causes the problem. So I hope that brings you some information of what I'm looking at. One other question someone asked me about is Elliott Wave. I've looked at Elliott Wave way back in the early 70s with John Hill, And this is long before Proctor started doing it in 76, I believe. I had trouble looking at these little sub-5, sub-3s, and all that stuff. Basically, to me, it boils down to A, B, C, D. If prices are going up, there's more buyers. If prices are going up, there's more sellers. And you know they can't hide from you. They can lie, cheat, do whatever they want, but they can't hide. If prices are going up, more buyers. Prices are going up, more sellers. And you see that today in Twitter. Okay, I hope that gets us to us. We're going to have Stan the Man Harley from Harley Stock Market Letter will be with us here at the break. And hopefully he'll give us some information of what he's seeing in the market. And, of course, he has been bearish, so he should have some pretty good ideas of where we are in some of these markets here. So stay tuned, and we'll have Stan Harley.
Larry Pesavento watches the markets 24/7, and now is a great time to try out his daily trading service, Fibonacci 24/7. Larry publishes videos and charts for subscribers throughout the week when warranted, and every weekend he puts out a thorough report covering worldwide markets, futures, commodities, and currencies with Fibonacci retracement levels, possible trading setups and zones, and stops and targets for all recommendations included. Larry applies the principles he's developed over decades of trading while analyzing a variety of markets for subscribers. To see for yourself the types of videos, charts, and analysis that Larry provides for his subscribers, sign up for Fibonacci 24/7 today by visiting the front page of TFNN.com under the newsletter tab. You'll also gain instant access to Larry's archived subscriber webinar from earlier this year. New subscribers get a 30-day money-back guarantee, so you have nothing to risk. Sign up today. If you're a trader in the market looking to find the path that leads to maximizing profits while decreasing risk, then now is a great time to try out Dave White's daily trading service, The Path of Least Resistance. Through the use of options and equity trades, Dave advises his subscribers on a daily basis of the current market conditions and what possible trade setups are on the horizon. The Path of Least Resistance is published every trading morning, often with updates intraday when initiating trades or closing out positions. Dave White has advised his clients of some outstanding winning options and equity trades in recent months, and now is a great time to try it out for yourself. New subscribers to the Path of Least Resistance receive a 30-day money-back guarantee. See for yourself the types of options and equity trades that are available by signing up for the Path of Least Resistance today by visiting the front page of TFNN.com and selecting the newsletter tab. Sign up today.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartleys, ABCs, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com. This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Okay, we're back, folks, and I believe we have Stan Harley, the Harley Stock Market Letter, on the line. Stan, are you there?
Good morning, Larry. How are you doing?
Good morning, my friend. Well, you're getting ready for November the 3rd. I have you scheduled for November 4th, but we had to have you on a week early because you've been giving us some really good information. And the folks wanted to get your opinion because you've been bearish and the market's been down since you said it would top around October the 11th. And we're going to put you on the spot two ways today. A, who's going to be elected? And B, where's the market going? Other than that, we don't have anything.
Other than that,
yeah.
Historically, the market tends to foretell who wins the election with a pretty good, reliable consistency. If the market is measured by the S&P for about 2 to 3 months prior to the election is up, that tends to favor the incumbent party. On the other hand, if the market is down, that tends to favor the challenger. So as one can see, the market has certainly been lower here compared to where it was a couple of months ago. But let's talk about the market action and what I see developing. With you on the air here, I've been espousing the theory that we would probably hold up into the election time period. I've changed my views on that. I'm of the opinion now that we probably have the market top in the rearview mirror. And I have a number of reasons why I believe that's the case. I've got 4 charts we brought here today. The first one is a weekly chart of the S&P 500 cash index, going back to the 2002 time period. And what I've done here is I've drawn a large vertical line right at the March 2009 bottom. That was a major bottom on March the 6th. And counting both to the left and to the right of that date, Fibonacci and Lucas numbers, I found that all of the important lows can be defined by those numbers. For example, if we go to the left in time from that March 09 bottom, it lines up with 322 Lucas weeks with the October 2002 bottom. And if we go to the right in time, 144 weeks, that lines up with the October 2011 low. If we go to the right in time, 377 weeks, that lines up with the February 2016 low. And I put these numbers below into a spreadsheet, done what's called a regression analysis, so that if you find the best mathematical fit, these numbers fall out very nicely. And then last but not least, if we go to the right in time, the next Fibonacci number in the sequence, which is 610, it lines up beautifully with the September 2nd high of this year. And then down below with the spreadsheet, you can see when I've crunched the, when I crunch the numbers, it comes out to be 609.82, rounded off to 610. What does all of this mean, Larry? We've got a phenomenal Fibonacci Lucas setup for all of the major lows, and then right into the September 2nd, 2020 high with Fibonacci relationships. It doesn't get any better than this. The next slide I brought is something that I've talked with you a little bit on the air, but I haven't really showed it in chart form until today. This is a cycle I've tracked for many years. It averages 7 years. The regression analysis has a cycle computed at 82 months, which is just 2 months shy of being exactly 7 years. But this has been the dominant cycle for the last 20, 30 years. The 4-year cycle was very dominant throughout the 1960s through about 2002. But then the 7-year cycle has sort of evolved to become more dominant, certainly in recent times. And what I've done here is I've got the price chart on the top, and I've shown the major bottoms, and then with the little triangles at the bottom of the chart, that's what the regression analysis has done to compute the idealized cycle point. And you can see very easily that lines up exceptionally well with the actual lows. The next low in the series, should the pattern continue, based on the regression modeling, is December 2022, and the standard deviation on that analysis is about 7.5 months. So what does that tell us? The next low, should the pattern continue, in this 7-year cycle should occur in the vicinity of December 2022, a little over 2 years from now, with a standard deviation, as I said, about 7 months. And I actually think it's probably going to come in December of 2022.
Wow.
Over 2 years from right now. Of course, before you make a low, you have to make a high. And that brings us to the next chart here. And this is kind of a busy chart when it comes up on the screen. But what I've done is I've looked at the last four 7-year cycle tops, not the bottoms, which was the prior chart, but these are the tops. And Larry, we have an interesting pattern that can tell us a lot about how tops occur. Tops are different from bottoms. Bottoms tend to be one and done. They tend to be a V-shaped occurrence. You tend to get a spike low, and that's it. Sometimes there's a retest. Sometimes, more often than not, there isn't. But tops are very different. They tend to be protracted evolutionary processes that span many, many months. So what I've done here for the last 4 7-year cycle tops, I've shown the evolution of what I call the big 5 indices. For me, the big 5 are the Dow Jones Industrials, the Dow Jones Transports, the Nasdaq Composite, the S&P 500, and the New York Composite. And I track all 5 of those, and what I found is, as the top is being formed, fewer and fewer components among this big 5 tend to top out. So very early on, say, for example, at the top in the 1999 to 2000 topping process, very early on, we saw the Dow Jones Transports top out in May of 1999. Then in January of 2000, the Dow Industrials topped. Then in March, first the NAS topped, then the S&P, and then last but not least, the New York Composite topped. And that was the final topping component, and that completed the topping structure. And then from that point, the market headed south. I've also shown the same pattern for 2007 to 2008. I showed it for the 2015 to 2016 topping evolution. And then at the very bottom is the current market environment. In January of this year, the first component among the big 5 to top out was the New York Composite. Then on February the 12th this year, the Dow Industrials topped. On September the 2nd, the S&P and the NAS peaked out. And the last component to peak out was the Dow Transports a week ago. So one can see we tend to get a thinning in the advance. We get fewer and fewer components among the big 5, making new all-time highs. And then when the final one peaks, that's it. The top is essentially complete. What is also very interesting is the Dow Transports seem to be a pivotal component. They are either the first or the last to top out in every occurrence. And I don't know why that is. It just is. And back in 2000, 99, 2000, transports were the first. In 2007, 2008, they were the last. Most recently, they were the last.
Hey, Stan, stay with us, buddy. We've got one more section to go. 877-927-6648.
Hi, folks. This is Tom O'Brien. The printing presses are working 24 hours a day, 7 days a week. The U.S. deficit has risen 200% in 1 year with no end in sight. The markets are looking for an additional stimulus bill to get us through this once-in-a-generation pandemic. There is no free lunch, folks. The more stimulus dollars put into the marketplace, the less your dollar is worth each and every day. This is the time to protect yourself with a portion of your portfolio in the metal market. The Gold Report comes out each Monday morning. I bisect and dissect the dollar, silver, gold, the XAU, and the HUI. The Gold Report is a long-term hedge against the dilution of your buying power. The U.S. has put more than $6 trillion into the marketplace in the last 6 months, with more expected in the next few months. The market did and does need the stimulus, but it will have long-term implications on our buying power. The Gold Report comes with a 30-day money-back guarantee. Go to TFNN.com and order the Gold Report now. Protect your buying power. Order the Gold Report now.
Will the S&P 500 continue to climb? For bold trades on U.S. large-cap stocks in either direction, trade SPXL, SPUU, or SPXS. Directions Daily S&P 500 Bull and Bear Leveraged ETFs. Direction Leveraged ETFs. An investor should carefully consider a fund's investment objective, risks, charges, and expenses before investing. A fund's prospectus and summary prospectus contain this and other information about Direction shares. To obtain a fund's prospectus and summary prospectus, call 866-476-7523 or visit directioninvestments.com. A fund's prospectus and summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
Many of our new listeners have heard about the Tiger's Den. The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of the TFNN shows, plus see all the charts as they happen live and have access to archives of all of those charts. You can test drive the Tiger's Den absolutely free for 30 days and greatly enrich your knowledge of these markets and how to make your money work for you. Details on the Tiger's Den are on the front page of TFNN.com.
TFNN has launched our brand new website. You can still visit us at the same TFNN.com URL, but when you do, you'll see a new and improved homepage with a much simpler navigation, whether you're watching Tiger TV live in high definition or just accessing your newsletter subscriptions. We even have new pricing in 6 months and yearly options. Check out the new TFNN.com now and experience all the upgrades. TFNN.com, educating investors.
The Bull Bear Trading Hour with Tom and Tommy O'Brien. Next.
Okay, we're back, folks. We're talking with Stan Harley, the Harley Stock Market Letter. Stan, you've got a really interesting similarity here between 1929 and 2020. You want to explain to the folks what you're looking at here?
Absolutely, Larry. I find this very interesting indeed. Back 100 years ago, the general proxy for the stock market was the Dow Jones Industrials. When most people refer to what is the market doing, well, one often referred to the Dow Industrials. Well, in recent years, that's kind of changed, and now most people, certainly professional money managers, and most of us who watch this program, to us, the market is the S&P 500, and that's what most professional money managers look to is the S&P, and every morning we get up, we want to see what the S&P futures are doing. But I found this absolutely fascinating. I've got two charts of the market. On the left, as measured by the Dow back in 1929, and on the right, as measured by the S&P 500 through the present. Take note of the date that the market topped in 1929, September the 3rd, 1929. The market then sold off for about 2 months, and then it popped up and it made a right shoulder on October 11th, 1929, and then it continued to sell off fairly sharply into mid-November. All right, let's look at the 2020 chart. Where did the market top? The market now, the S&P 500. The market peaked on September the 2nd, sold off for a couple of months, came up and made a right shoulder on October the 12th. Isn't that interesting?
Wow, that is incredible similarity, isn't it?
Is that just cute?
Yeah.
Or is that I mean, 1929 and 2020, both the tops and the right shoulders are within 1 day of each other. That's on the calendar. That's just too cute. I find that fascinating.
Well, if that's the case, then we should bottom around November the 13th, then, if they're going to retain that similarity, aren't they?
Well, yeah, we shall see. Yes,
this is true, said the blind man, yes.
And positions work for a while, and then they don't work right when you expect them to. But certainly, if we continue to follow the pattern essentially day for day, you're right, that would suggest a mid-November bottom.
Uh-huh. Do you have anything on your shorter term? I know you don't have a chart for it, but do you have anything that is looking like mid-November might be some type of a low? You got any counts out there that might be?
I'm going to refrain from that for right now. I'm inclined to believe we're probably going to be down into year end, but yeah, we'll talk about that in the weeks that come.
Okay. Well, that's great. I mean, this chart itself pays the admission. I mean, this is incredible similarity. My gosh, you can't fool that. In fact, we were watching that area in the S&P because it was at a 78% retracement up there, and that was really one of the areas that we look at with a really nice ABCD pattern. So this and this market has not given us any indication that it wants to bottom yet. So this is really great information, Stan. Thank you very much. Can you tell the folks how they can reach you if they'd like to subscribe to your letter?
Oh, they can. I have a website, harleymarketletter.com.
Okay. All right. Listen, thanks for joining us, my friend. And we'll have you in November sometime, hopefully in a couple of weeks. And if we're still around, if there's no revolution, maybe we'll have another show with you. Okay. And stay safe, my friend. We're in the age bracket where we got to watch where these young people are running around. So stay safe.
Absolutely.
Okay. Thank you very much, Stan, for joining. We really do appreciate it. It was a great show, too. Just super information.
My pleasure.
Okay. Well, we're going to have Stan back in the middle of November to take a look at. But this chart here, I think, is really incredible, looking between the similarities of 1929 and 2000. Remember that Andrew Lowe said these markets repeat, and they do it with regularity. So this is a very, very interesting chart to pay attention to. And with the way the market is acting, we could certainly look like, if we break 3220, you're going to be looking at a big 1.618 expansion that's going to take it down to at least the 2950 level in the S&P. And so that could happen, very, very quickly, given the scenario of change administrations or change of underwear, whatever they're doing over there, that could easily do it. So we got to pay very, very close attention to that number of 3220. That would break. And the most important thing is because we look at patterns, and when patterns fail, that tells you that you've got some real trouble in River City. And if you look at this chart here, you'll see that you have to hold 3225. And if we break below that, if you break below that, you're breaking below the 3 drive to a top bottom pattern that took 2 days to form. And you'll be breaking below the 78% level when it comes in around 3240. So that's neither here nor there. So those are, we've got some major stuff coming up here between now and Tuesday. Well, Tuesday is the big thing, but it's going to be interesting to see what's going on. Market Marshall is pointing out that is a 5-point reversal also. So that means that there's a lot of buyers came in at that point to to prop the market up, and it showed what it did. And what did we do? We rallied. Last night we rallied all the way up to the 61% retracement level. I mean that came in at 32.90, and it was flat out spot on. So it's telling you that there's some kind of bottom in there, and that's important. And look at this here. And if we look at the Nasdaq, here's another one here. Look at the Nasdaq. If we break that 3 drive to a bottom way back down there at the 10,700 level. Of course, we're 500 points from there. I mean, that's going to be some serious stuff. So, hey, this market could heck of a rally. So right now there's some support here, but whether it's going to hold or not, I don't know. This is a Friday, which is a great revelation if you follow the calendar. It'll be followed closely by Saturday and then by Sunday. But this weekend will be very, very important. One that we are really watching, folks, for a potential bottom is the gold market, and we've been bearish this for quite some time. Those of you that are in the bonds are still acting very nicely. Make sure you don't let the market get below 172.16. We bought her at 172.24 last night, and they're acting okay. But if they get below that, you don't want to mess with it. But they've been very good to us this week. They've had a 4.5-point move in bonds, which is one of the more quieter markets considering what we're looking at here. Also, the euro, folks, the euro has, really coming down to where we think is going to be some major support here in the euro. So we've got to let's see if we can get it up here. You'll be able to see it. That we'll be watching it here coming in because we've broken down badly now. We're very bearish up there at that 61% retracement, 118.75. We're now breaking below 117. That sets up The 382 where it says support there at 115.40. I think we're going to get to that, which will be another ABCD to the downside also. So all of this will probably happen in the next few days because of the increased volatility that we'll see. And you know why I'm saying increased volatility? This thing could fall asleep and nothing happens. Who knows? So we'll see what's going on. So anyway, we'll be right back. 877-927-6648.
Back in the day, I joined Hotel California in 2006, and like many of you, was drawn in by, as well as...
Whatever you think about, you bring about. Whatever you focus on grows.
You see, I believe that everything in life happens for us, not to us. And Tom ignited the fire within me to want to learn how to master the markets. So how did I go from knowing nothing about technical analysis to becoming the #1 market timer for the S&P 500 in 2018 and the #2 market timer in 2019? Simply put, I hired coaches with a proven track record, which led me to a whole new set of tools that I created to interpret the message of buyers and sellers. I would love the opportunity to teach you this award-winning set of tools and help you improve your market timing. You can test drive my newsletter service, Mastering Probabilities, for the next 30 days with no risk to you. Plus, you'll gain access to archive workshops that'll take you step-by-step through my system. Sign up today by going to the homepage of TFNN.com and selecting Mastering Probability in the newsletter tab.
If you haven't checked out the newsletters page of TFNN.com, what are you waiting for? All of the TFNN newsletters are informative, up-to-date, affordable, and a must-have for every trader looking to gain a competitive informational edge in today's markets. TFNN newsletters cover every aspect of the markets to offer you the very latest in market news. Plus, new subscribers get to test drive our newsletters risk-free for 30 days. From all aspects of the markets, including stocks, bonds, metals, commodities, and tech, there's a newsletter to fit your needs exclusively from TFNN. Stay informed each day you trade and get that competitive edge that will help you stay ahead of the game. Visit our newsletters page by going to TFNN.com and click the newsletters button near the top of the page. TFNN.com, educating investors.
With markets trading with extreme volatility and peaks and troughs everywhere, regardless of what you're looking at in the markets, this is a great time to see the type of analysis Basil Chapman delivers for his subscribers every market day with the Opening Call newsletter. Basil has been analyzing markets, providing his take for subscribers to his trading services since 1984. Every morning, Basil publishes an update for his subscribers, along with weekend and evening updates when warranted. The Opening Call provides traders a daily market overview with regard to the direction of the key indices, selective stocks, and commodities, along with specific recommendations, including stops and targets. You also gain instant access to Basil's subscriber webinar archive from earlier this year, a dark cloud cover, and essential market analysis. Ride the Chapman wave today by signing up for the Opening Call newsletter on the front page of TFNN.com under the newsletter tab. New subscribers get a 30-day money-back guarantee, so you have nothing to risk. Sign up today.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Okay, folks, I posted a daily chart of the S&P. The 382 comes in there at 30.50, and the 50% comes in there at that 2,900 level that we possibly talked about. But folks, there's a lot of things going on here. What I want you to notice here, the big drop that we had in February, you'll notice where it says the key time there. That's what you have to watch if you're waiting for a crash. Wait for the first big break, and then watch for the pullback. You see, it had a nice 4-day pullback there, and then gave up the ghost those are the easy ones to look at. So, you don't have to pick the exact top there. You don't get extra things on your equity run that says, gee, he had the exact top. And believe me, there's only a few people that get that price. Me, and I don't know who the other guy is, like I ever had that happen. Well, maybe once in all these years. But let's take a look what happened this morning. Just looking at it here, just to show you how volatile these markets are and why you've got to be so careful. This is just a 2-minute chart showing in the S&P here today. We went from 32.65 all the way up to 32.97. That's 20 handles, and then we're down 20 handles. I mean, that's how quickly it's going up and down, folks. So you've got to be prepared to use a tool that's going to keep you from, risking an arm and a leg. Pretty soon you'll be a quadriplegic if you keep risking too much. You've got to quantify your risk, keep them as low as you possibly can. Mr. Z's asking whether the 1859 is the low for the gold. I don't believe so. I believe we're going to go down to 1810, but I could be wrong, Z. As you know, I'm wrong a lot. Quite seldom, but we have to watch it closely. I still think it's there, and the reason why is I'll post it one more time, and that is we still have these multiple ABCD patterns coming in here at the 1810 level, and if it does that, then I will certainly look to be a potential buyer. Also, that GDX is getting very interesting down in here because it's had a really good pattern that we posted here several times. So live every day in an attitude of gratitude, folks, and do something nice for someone that has a whole lot less than you, and there's a lot of people like out there. And remember, we'll be back Monday, and then Tuesday is the big day. Shane Smolian will be our guest on Monday. He's going to have some stuff on COVID and also the election.